How's it going? Welcome to the Week in YouTube Finance. First things first, check this out. Message of the week. Big thanks. Big thanks.
Thank you so much to B-Ham and the family.
Shout out. How cool is that? I'm definitely sending up subscribe back that way. Thank you so much. Really cool. Now let's check in with Andre, see what he's got going on this week.
Okay, so what if the same company that broke Wall Street just made a move that could break the internet? GameStop, the original meme stock, just announced that it's adding Bitcoin to its corporate treasury. So now it's 100% confirmed, and it could be the beginning of a brand new era. Not just for Bitcoin, but for you as an investor. Because if this plays out the way that some people are saying it will, it could signal a shift in how corporations hold money and unlock a wave of new Bitcoin adoption that affects every portfolio in the world.
Everybody.
So let me break down exactly what's happening, why GameStop did this, how it fits into the bigger picture with Tesla and MicroStrategy, and what it could mean for Bitcoin's price in the next few years of investing. So let's get into it. Hi, my name is Andre Jick. Hope you're doing well. Come for the finance and stay for GameStop. Now, on March 25th, GameStop announced they're officially adding Bitcoin to their balance sheet, and that move is approved by their board. And this means they're now converting a portion of their corporate cash, which is usually sitting in either dollars or short-term investments that pay them a small interest, into Bitcoin and holding it as a treasury asset. Now, unfortunately, they didn't reveal the exact amount they'll be investing just yet, but GameStop has about $4.8 billion in cash. So even a small percentage could end up being hundreds of millions of dollars flowing into Bitcoin. And we actually do have a clue how much they might be considering. Michael Saylor's company Strategy tweeted that Mara might have some competition soon, and Mara holds 46,000 Bitcoin. That's worth about $4 billion. And here's the crazy part. They didn't even set a cap. They're open to accumulating more over time. And this decision was backed by their board, led by Ryan Cohen, who's been quietly signaling this move for months, including a tweet of him with Michael Saylor, whose company now holds the most amount of Bitcoin out of any company in the world. And it gets even better. This wasn't just GameStop doing this for fun. Strive Asset Management, who's a major shareholder in GameStop, wrote a letter publicly telling them to adopt Bitcoin, calling it an incredible opportunity to protect their treasury from inflation and build long-term shareholder value. So this wasn't random, it was very strategic. But now let's zoom out and ask the question, why are companies buying Bitcoin at all? And there's three main reasons. Number one is it's an inflation hedge. With central banks printing money, the value of cash is constantly going down. In fact, if you look at the true inflation data, you're gonna find that since 2020, not that long ago, $1 will now only buy you 74 cents worth of stuff. So it's not just people losing purchasing power at the grocery stores, it's also the corporations that hold cash as part of their reserves. So holding Bitcoin is like holding digital gold with a limited supply. Now, reason number two is long-term appreciation. Bitcoin has been the best performing asset of the past decade, even factoring in all the volatility. And companies want to make money not just by selling products, but by being good investors of their cash. And reason number three is signaling innovation. Because holding Bitcoin sends a message to the market that it's forward thinking, it's trying to understand where the world is going, and that they're not afraid to lead. And that helps boost stock prices, which makes shareholders happy. And it's not just a theory either. This is not the first time that this strategy has been used. Let's go back to August 2020. MicroStrategy, a business analytics company, became the first public company to go all in, and CEO Michael Saylor turned $250 million in corporate cash into Bitcoin and then just kept buying. Today, they own over 500,000 Bitcoin, representing 2.4% of all Bitcoin in existence, worth over $40 billion, and they just rebranded to Strategy to reflect that Bitcoin is the core of their business model. Then in 2021, Tesla made headlines when it bought $1.5 billion worth of Bitcoin. And that alone pushed Bitcoin up 20% in just one day. And that made it mainstream. For a while, Tesla even accepted Bitcoin to buy Teslas. And then Square, now called Block, followed shortly after that, with CEO Jack Dorsey saying Bitcoin is the future of money. So the list kept growing. Coinbase, MassMutual, and dozens of other companies are quietly buying and stacking Bitcoin while the world debated if it was a bubble or not. Now in 2025, GameStop joins that list, and this time they're doing it with better timing, more regulatory clarity, a community that's already proven it can move markets, and a president that just announced Bitcoin is part of the US strategic reserves. But now let's talk about what this actually means for the price, because the question is, does GameStop buying Bitcoin actually move the price? Now in the short term, not really. GameStop did go up about 15% this morning, but the famous Josh Mandel, who correctly predicted Bitcoin at 84K and that Bitcoin's gonna go to 444,000 this cycle, says he's actually shorting GameStop. So it's anyone's guess what's gonna happen in the short term. But long term, this is where it gets really interesting because Bitcoin has a fixed supply and corporate treasuries are massive. So if just 1% of the S&P 500, the stock market, adopts a Bitcoin treasury strategy, it would inject hundreds of billions of dollars into the asset, tightening supply, boosting demand, and pushing prices higher. But it also creates a higher low, a higher floor for Bitcoin with each and every cycle, because it has that many more new investors that want to buy it when they see it as an opportunity and the price dips. And it's not just about one company, it's about the message that this is becoming normalized. Just like ETFs and institutions are onboarding millions of new investors, companies stacking Bitcoin is another vertical. And here's the craziest part. When Tesla bought Bitcoin, they held it for months and it still affected the price. MicroStrategy said they're gonna hold and never sell. And that means the supply is effectively off the market. Michael Saylor himself says he plans to burn his own private keys to his own Bitcoin as a gift when he's gone. And less supply equals higher price potential. So the question now is, will other companies follow? And the answer is, most likely. GameStop is not a financial company or even a crypto native company. They were a retail dinosaur that's reinventing itself. And if they can do it, what's gonna stop other companies from doing it? Companies like AMC, Chewy, Shopify, even Apple could be watching really closely right now, especially if GameStop's price reacts positively and their treasury actually grows in value. The biggest risk is fear, because most C-level executive people that run companies don't want to be the first to bet their company's money on Bitcoin, because if it goes down, jail. No, not really, but they might lose their job. And now though, the United States is gonna start buying soon, so they're not gonna be the first, they're not even gonna be the second, and the more that jump in, the safer it becomes. It's a classic S-curve of adoption, and we might just be right at that acceleration point. But now let me just tie it all together and let's bring it back to the investor that might be watching this very boring video that I put together last minute. So what happens to our portfolios? So Bitcoin is going mainstream, and the story has changed from what if it fails and is it a bubble to what if this becomes part of every major balance sheet on Earth. So the opportunity is still what people call asymmetric, meaning the risk to reward is still so imbalanced that it's in favor of at least having some than not having any at all. And if corporate adoption continues, I think we're still early. Bitcoin might already be close to 100K, but the road to 250 and 444 and 500 or even a million isn't that crazy in this context. Now for me personally, Bitcoin still represents between 25 to 30% of my net worth, depending on the day. And my logic is I'm younger and I can take the risk and the volatility, but that might not be true for everyone. I can make a separate video about that. But I do think that there is a risk. In the future, as more and more companies start to adopt this strategy, crypto-themed stocks will probably become the new altcoins. So just be careful when that happens and which companies you choose to invest in. But overall, this is history repeating itself. First it was gold, then it was cash, and now Bitcoin might be the next chapter in reserve assets, especially for my generation. So GameStop just made Bitcoin a boardroom asset. And it's no longer just retail versus Wall Street, it's Bitcoin on Wall Street, and that shift changes everything. And if you do decide to get some, this video is sponsored by yours truly. If you'd like to learn how to self-custody your Bitcoin and how to protect it, I have a step-by-step video guide that teaches you how to do exactly that. And as a thank you for making it this far into this unscheduled video that I was not planning on making, you can use coupon code Andre40 to get an additional 40% off the training series. If you found this helpful, let me know. I'd love to hear your thoughts. I hope you have a wonderful rest of your day. Smash the like button, subscribe if you haven't already. I'd love to see you back here next week. I'll see you soon. Bye-bye.
Hey everybody, welcome back to Whiteboard Finance. My name is Marco,
What up,
and
Marco?
boy do I have a banger of a video for you today. The trade war is back. So why is tech tanking and what is next? Let's get right into it. So I'm recording this at like 6 in the morning the next day. I wanted to wait till all this news actually settled, and then I wanted to actually get a screenshot of the market's close from yesterday. So you can see all these tech stocks selling off. You have Google, Amazon, Meta, Tesla, Apple, Nvidia. They're all down 5, 6, 7, 10%, right? And then look at this little Lone Ranger right here. AMD, baby, advanced money destroyer. So let's get right into it. So why is this even happening? So the trade war is back, and no one seems to be talking about how serious this actually is. So markets have been hanging on to this idea that April 2nd, what Trump is calling the reciprocal tariffs day, is going to actually bring some clarity to the markets and what's ahead. But here's the deal. The day might actually be the start of even more chaos. So in fact, tech stocks, which I just showed you, alone have lost $400 billion this week. Why? Because smart money is realizing that uncertainty is about to spike. So let's take a look at this. So for the last week or so, the markets were actually starting to price out tariff uncertainty. So if you look at the left side of the chart here, markets bottom as tariff headlines stall, and then you can see the Wall Street Journal reports potential leeway in tariffs. So this was March 24th. The Wall Street Journal hinted at some possible leeway on tariffs. Things were actually calming down until this morning, okay, at the time of this recording. So let's take a look at the rest of this. We have stocks pricing out tariff uncertainty right around here. Okay, this was the 25th. And then look at this. The auto tariff headlines emerge. So what are those auto tariff headlines? Bloomberg drops a bomb that Trump is prepping auto tariffs, and they could hit as soon as today, okay, at the time of this recording. This isn't just noise. Remember, Trump already gave automakers a 1-month delay. That is expiring. So the S&P 500, which has already been stalling, it's sitting at right around the 5,800 level. So markets are nervous, and now we know why. So take a look at this. President Donald Trump is readying an announcement on auto levies as soon as Wednesday, according to people familiar with the matter. The people shared the timing of the expected announcement on the condition of anonymity to discuss plans not yet made public. So if we take a look at the Trump auto tariff announcement, you know, everything starts tanking, even though U.S. markets form a lower high. I've never seen markets this volatile. I've been investing since 2006, you guys, since I was 18 years old, okay, senior in high school, freshman in college. And I've seen 07, 08, I've seen, you know, pandemic drop, you know, 30, 40%, but nothing on a daily basis like this. This is super volatile, you guys. So people think that April 2nd is going to end this confusion, but actually I think the opposite. So Barclays says these reciprocal tariffs could hit up to 25 countries. Think about that. So industries like autos, pharma, semiconductors, these are all in the crosshairs, okay? It's all fair game. And countries are not going to sit back and take it. They're going to respond. So that's why I'm calling this video Trade War 2.0. So take a look at this. Trump may slap reciprocal tariffs on as many as 25 countries on April 2nd, according to Barclays. Barclays analysts expect former President Trump to announce reciprocal tariffs next week on 15 to 25 countries with large trade imbalances, with the U.S. sectors likely affected include autos, huge industry, pharma, huge industry, and semiconductors, huge industry. Read The Chip War if you haven't. It's a good book. So we can see how this is affecting NVIDIA. So you want proof? Here you go. Just look at NVIDIA. It's down 7% in 2 days. It's no longer the most valuable publicly traded company in the world. They do over $17 billion in revenue just from China alone. So investors know that a tech cold war is coming. And it's not just stocks dropping. Foreign investors just pulled out $6 billion out of U.S. equity funds. That's the third largest withdrawal on record. Institutional buyers, they're out too. Hedge funds, they're dumping global stocks at the fastest rate in 4 years earlier this month. So take a look at this chart. Biggest foreign selling off of U.S. stocks since March of 2023. Foreign domiciled U.S. equities fund flows, weekly and 4-week moving average in billions of dollars. So if you look at the light blue, that's U.S. equities fund flows, foreign domicile in billions. You can see that right here, March 25th. And then look at the dark blue. That's the 4-week moving average. Look at this huge spike down going back to essentially zero, okay? So this is Bank of America Global Investment Strategy. All my stuff is sourced. Sources are disclosed. So if we keep going, take a look at this chart. These are global equities. This is the 2-day gross flows. Look at that red circle right here. You can see how much was taken out just over the last few days. So meanwhile, retail investors, they're buying the dip. Okay, everyone's been buying the dip, just like 2021. So Wall Street, they're not buying it. So this divergence is dangerous. You have mom and pop retail investors that are taught, they're trained to just keep buying. Stocks are on sale, right? And you should, because if you miss out on just a few key trading days, that can make a huge difference in your portfolio. So I stay invested, and I typically just dollar cost average. My philosophy has always been on this channel, the money printer is going to keep going, right? M2 money supply just goes up and to the right. What do you think is going to happen to assets? They're going to go up and to the right. Housing, stocks, precious metals, Bitcoin. As long as M2 money supply keeps growing, assets are going to go up and to the right. That's why the difference between haves and have-nots keeps getting bigger and bigger. So let's not forget, Trump has made it clear he's willing to accept short-term pain for long-term gain, okay? His cabinet agrees. And with inflation still hot, don't be surprised if Jerome Powell plays along. So let's break it down. Let me conclude all this, and then I actually want to get back to the chart that I just had on the screen. I want to talk about it. So investors are mispricing risk, retail. Tariff uncertainty is rising. Foreign and institutional capital is backing out. Tech is no longer leading, and Trump is ready to weather near-term weakness. So in my opinion, this is not a great recipe. You can see all the big money, all the smart money. Go watch all my videos from the past month. You can see all the big money, all the hedge funds. They're getting out of the Magnificent Seven. They're getting out of U.S. domestic stocks. You just go watch those videos. So let's get back to that chart real quick that I wanted to show you. So this is 100 years of equity market concentration, okay? The equity market is currently near its most concentrated level in 100 years. So if you look at the gray line, that is the weight of the top 10 stocks in the S&P 500. This is at all-time highs, you guys. Okay, this is the tech stocks. This is, literally whatever the top 10 are, which are mostly tech. It's Magnificent Seven and a few more. But if you look at every time this happens, there seems to be a recession, right? Dot-com bubble, 2000, 2009, 2020, and then look where we are again. We're at all-time highs again, you guys. So I think this is very important to study. At the end of the day, if you think that American exuberance and all that stuff and all the best talent from around the world still comes to the United States and we have the deepest capital markets in the world, then stay invested, right? Most of my net worth is in VTI. It's a total U.S. stock market fund. And I have a good chunk of change there. It's not immaterial. So I share all that stuff with you guys in Whiteboard Finance University, my buys, my sells, my trades. We have courses. We have everything. It's a great community. Go check it out if you haven't already. But if you want to see exactly how I'm navigating this volatility, check out that link down in the description below. So build your foundation, protect your portfolio, profit during this uncertainty. And as always, sorry. Gently click the like button.
Sure.
Gently click the subscribe button. Gently click the bell to get notifications. Share the video with 3 friends. Okay? And as always, have a prosperous day.
Thanks.
Dude, imagine how much insider trading is going on with this volatility. All you have to do is tweet something. Okay? You can move markets like crazy. Hundreds of billions, trillions of dollars being moved. Go watch the S&P 500 chart. It's like a roller coaster. It's unreal. I've never seen anything like it. Peace.
That's cool. Lots of information there, huh?
President Trump is right. We should junk the debt limit.
Checking on Forbes.
Hello, I'm Steve Forbes, and this is What's Ahead, where you get the insights you need to better navigate these turbulent times. The Congressional Budget Office announced this week that the U.S. government will run out of money this July or August unless Congress raises the debt limit, which puts a ceiling on what Uncle Sam can borrow. Congress should have raised the limit at the beginning of this year, but didn't. Since then, Washington has been using cash reserves and so-called emergency measures to pay its bills. Delaying taxpayer refunds is one possible ploy, and playing around with the civil service pension funds is another. Revenues surge in March and April thanks to corporate and personal income tax deadlines. A smaller bump comes in June when quarterly tax payments come due. But not long after, the till runs out. If the debt ceiling is not raised by then, the U.S., for the first time in its history, could default on its debts, either by missing interest payments or not redeeming maturing bonds. If that actually happened, shock waves would hit the financial markets around the world. We came close to that in 2012. Faith in the dollar would be damaged and its value would go down, a surefire formula for future inflation. Interest rates on bonds would go up. Now, the debt limit has been around since World War I. Defenders say it is a crucial tool to stop even more spending. Well, we painfully see today how well that has worked in forcing fiscal prudence. Raising the debt ceiling is often preceded by lots of drama. Social Security benefits and payments for Medicare and Medicaid will be in danger, are routine cries. Resolving the crisis then requires deals with various congressional members to get the job done. In fact, too many times the process has ended up generating even more spending. So President Trump was right last December when he called for dropping the debt limit altogether. Fiscal sanity won't come from what is a charade. So let's stop the pretense and focus on real measures to get our financial house in order. Productive policies would include cutting tax rates, cutting unnecessary spending, rooting out waste, fraud, and abuse, pursuing deep deregulation, generating more revenue from expanding energy production. Does all this sound familiar? Another necessity is forcing the Federal Reserve to focus on stabilizing the value of the dollar rather than suppressing economic activity. For now, congressional Republicans seem likely to include a big boost in the debt limit in its upcoming tax cut legislation. But after that, let's retire the debt limit show to the Smithsonian. I'm Steve Forbes. Thanks for listening. Do send in your comments and suggestions. I look forward to being with you soon again.
What's up, you guys? It's Graham here.
What's up, Graham?
And let's just get some of the bad news out of the way first. As of now, the typical American saves just 3.8% of their income. First-time home buyers have fallen to a historic low as they're priced out of the market. Nearly half of all Gen Z is forced to work multiple jobs. And if that wasn't bad enough, credit card and household debt has just hit an all-time high. Fortunately, though, it doesn't have to be this way, and there is a solution for those who want to escape the hamster wheel and quickly build wealth, even if you're starting out with nothing. And better yet, it's not the generic cookie-cutter advice of work hard, save at least 10% of your income, drive a used car, and no matter what, hit the like button if you haven't done that already. Even though chances are that's still probably a lot better than what most people are doing. Anyway, in terms of getting ahead of 99.9% of people starting today and actually making a sizable financial difference starting from what you already have, these are my best recommendations that have worked really well for me that anyone could follow regardless of your background, income, or education. All for the price, by the way, of subscribing if you haven't done that already. So thanks so much, and also a big thank you to Helium Mobile for sponsoring this video, but more on that later. Alright, now before we go into the step-by-step details, I just want to say this. Be careful who you listen to. I just noticed there's a lot of people out there who are totally broke, but they love to give their opinion on what you should be doing at any chance they could get. These are the people who tell you that you should live it up when you're young, that credit scores don't matter, that you should go to college to get a job to be successful, or that starting a business is too risky and a lot of people fail, so chances are it's not worth trying. Now, don't get the wrong idea, because usually the people that say these things typically believe it themselves, and a lot of the times they have great intentions, unless of course they have deep-seated insecurities and don't want anyone else to do better than them, but the fact still remains. If you want to build substantial wealth, you have to go against the grain. You have to be a contrarian. You have to do what most people are not willing to do. And that also means only listening to the people who are where you want to be. In fact, I heard a saying out there that is incredibly true. don't take advice from someone who you wouldn't want to trade places with, and that is insanely important in determining who to filter out. This is going to help narrow your focus down only to the people who are doing what you want to do, and chances are that is the advice that you should follow. Second, since the goal here is to build wealth, we need to talk about actually making money. And one of the easiest things you could do to help you with that is to have a good credit score. The fact is, like it or not, your credit score rules all things personal finance. Like, it could dictate whether or not you get approved for a mortgage, could rent an apartment, get a competitive interest rate, get approved for a small business loan, or even pass a job application. This is why you could either choose to ignore it and pretend it doesn't matter, or use it as a real-life cheat code to immediately start making a lot more money. And if you want a guide on exactly how you could do this, here's my step-by-step recommendation. First, if you have no credit history whatsoever, go and apply for something free like a Discover It secured card. All you need to do is get in the habit of putting a few small charges on the card every single month, and then pay it off in full by the time it's due. That's it. Now second, right after doing that, go and sign up for a free credit monitoring website, including Credit Karma, MyFICO.com, or Experian.com. This one's going to help you monitor your credit history, and over time you could watch your score go up. Again, for free. Now third, after 6 months of doing this, go and apply for another free credit card, like the Bank of America Cash Rewards card, the Wells Fargo Active Cash card, or the Chase Freedom card. This is because the more on-time payments you have, the faster your score is going to go up. So now that you have 2 credit cards, you're going to put, again, small expenses on the card, pay it off in full by the time it's due, and repeat. Fourth, after 12 months of doing this, go and apply for your first charge card like the American Express Gold. Now this one does have an annual fee, but it comes with so many rewards that could easily pay for itself. And because this doesn't technically have a limit, it's going to help push your score up even higher. And finally, fifth, after about 18 to 24 months of doing this, you should have a credit score anywhere between 720 to 780, which will get you the lowest interest rates anytime you go and apply for a loan or leverage your money. Building your credit like this shouldn't take you any more than just a few minutes of work a month. And this is the ultimate cheat code to eventually making a lot more money, all for just watching a 15-minute YouTube video. Now third, even though building your credit could certainly help you grow wealth, it's not enough on its own to actually make money. That's why if you want to set yourself up for the financial fast track of a lifetime, it's extremely important to get as much work experience as possible. From everything that I've seen, it is always worth it to take a calculated risk, try new careers, be as busy as possible, and then just see what sticks. The reality is, every job you try is going to give you a new skill set that you could then leverage into the next position. And the more you try, the faster you're going to realize what you like, what you don't like, what you're good at, what you're bad at, and as a result of that, I promise, you're going to make a lot more money. Now, in terms of what you could specifically do, because I know everybody likes a step-by-step guide, this is what's worked really well for me. First, decide what you think your dream career is. Whatever it is, just pick that. Then second, start working towards it immediately. If this requires a special license, certification, some sort of job training, then work towards it. If it's something that people do on their own, like a lot of entrepreneurs, find someone who's doing what you want to do and see if you could work for them. Work for free if you have to, just to gain the experience that's going to pay off later down the line. Then third, after you've been trying it, if you realize that you don't like it, it's not for you, it's not what you expected, no worries at all, just start over again and repeat the process until you find something you really enjoy. Honestly, you shouldn't even be thinking about making money at this point, because I promise, the experiences that you get are gonna pay you 10 times more in the future, especially if you end up following these next few steps. Although before we go into that, I gotta say, now let's get back to the video. All right, now, in terms of getting ahead, if you wanna make a lot of money, as in more than $500,000 a year, you're probably gonna have to pick a business that's scalable. Like, let's be real. If you want to focus on massive wealth, chances are you're not going to get there through a traditional job, unless of course that job pays you an exorbitant amount of money, or you get really good at call options and OnlyFans. And that's why instead, you're going to have to pick a career that's not dependent on how many hours you work. If you choose to ignore the rest of the video and just focus on one thing, let it be this, because it's really important. Anytime you work a job that pays you a set amount, you're going to plateau rather quickly, because you'll soon find that there's so many hours in a day that you could work, and once you reach that point, you're pretty much capped out and done. However, by working any job that pays you based on results, assuming you get results, your income is going to skyrocket, because all of a sudden, the hours worked don't make a difference. For me, I did this through working as a real estate agent. It didn't matter if I worked 200 hours or 2 hours. If I didn't sell the house, I wasn't getting paid. So it was really up to me to utilize my time effectively and create a schedule that could maximize the amount of money I could make and the results that I could get. Personally, when it comes to this, I tend to think that sales is one of the most underrated careers out there. It's usually a stepping stone to a much higher income. The skills you will learn could be transferred to just about anything else, and that could provide the income needed for some of the other things we'll soon talk about. Now, of course, if you're not into sales or you want something that's a bit more stable, totally understandable, but do just consider that those who switch companies end up receiving on average 30% more money than those that don't. So see if there might be a better fit for you to work somewhere else and then leverage those skills to eventually make a lot more money. Best of all, pretty much everything you'd want to know is already on YouTube right now for free, and learning how to be self-sufficient enough to find those answers is going to help you tremendously long term. Although in terms of what you could do with all of that extra money that's soon about to come in, that brings me to the next step: creating multiple sources of income. Believe it or not, this step is so important that the IRS actually published their research on high-income tax returns to study the distribution of economic well-being, or in other words, why some people are richer than others. And what they found is that the more income sources a person had, the more money they usually made. Now, if you're curious which income streams are the most common, the largest usually comes from a typical job. This is where almost everyone starts off, and it's the equivalent of working a 9-to-5 job, running your own business, or working on commission. From there, this funds everything else that we're about to talk about, like number 2, dividend income. This one is pretty much the easiest second source of income that anybody would be able to do by buying into a stock, a REIT, an index fund, an ETF, or anything else that pays you a distribution on a regular basis. Third, we also have another one that's very closely related, and that would be capital gains. This one is often claimed as the way that rich people avoid taxes, but in all reality, the simplest reason is that capital gains are taxed at a lower rate than ordinary income. So instead of paying 37%, maybe you pay as low as 0 to 20%, saving you a lot of money on taxes. Fourth, once you start earning a lot of money, you could also branch into rental income. Now, even though this one is significantly harder today than it was when I first got started, there is still some opportunity in buying properties, fixing them up, and then renting them out. Yes, it is a lot of work, but with a steady income, good credit score, knowledge of the specific area, and the willingness to put in a lot of time up front, it can be profitable. And then finally, sixth, the last income source usually comes from a second job or a side hustle. I tend to believe that this is one of the most underutilized ways of making more money out there that people just don't take advantage of, especially when the average person is spending 2.5 hours a day on social media. Just imagine what you could do with that time if you actually applied it towards something productive. I just think working any type of side business that could be completely detached from your main source of income is not only a good thing to do, but it also diversifies you just in case something happens with your primary job and you need something to fall back on. Beyond that though, no matter how much money you make, if you actually want to build substantial wealth, you have to avoid what's called lifestyle inflation. This is what happens when you're making $40,000 a year, saving a little money on the side, no complaints, but then you get a raise to $60,000 a year. And all of a sudden, you get a slightly nicer car. Maybe you go out to eat a little bit more often. Nothing major, just small differences to reward yourself. But then a year or two later, you get a raise to $150,000 a year. And all of a sudden, your current apartment isn't cutting it, so you get a house. And all of a sudden, your car isn't just as nice as a G-Wagon. So you go and buy a G-Wagon because that's what other people making six figures are driving. You get where I'm going with this. I've seen so many situations where people are saving the same amount of money, making $200,000 a year, as the person who is making $50,000 a year, even though the other person's making 4 times more. And this is incredibly common. In fact, over half of people making $100,000 a year are living paycheck to paycheck, and a third of people making $200,000 a year can't save any money. So without going through their expenses line by line, my guess is that lifestyle inflation's to blame. Personally, I found that the only way to overcome this is that if you make more money, keep your expenses the exact same and invest the difference immediately. So that way, if you're making $40,000 and you get a raise to $60,000, nothing changes, except now you have an extra $20,000 to invest. This is not the time to spend the difference or reward yourself for working hard. This is the time to get your money invested so that way your money works for you and not the other way around. Or I guess you could just do what I do Work so much that you don't have any time to spend the money. Okay, in all seriousness, here's how I think about it. If there's something I want to buy, I think to myself, how much do I have to have invested to be able to pay for the thing? So, for example, if I want to spend $100 a week eating out, I know that I have to have $130,000 invested to be able to pay for it. That way, whatever I buy is sustainable and I'm never going to run out of money. I promise that by doing this, you're going to build a very strong financial foundation as early as possible. And that also brings me to my last point. Studies show that it's usually best to invest immediately. I know this is all super basic stuff on YouTube these days, but this concept of compound interest really changed my entire life as a teenager. Like, just consider this. $1 invested at 20 years old at a 7% return is going to be worth $21 at the age of 65. However, if you wait and invest that very same dollar at the age of 30 instead of 20, it's only going to be worth $10.68 during that same time frame. Like in this example, every $5 Starbucks that you splurge on could be worth $105 in future money. Those $100 shoes you wear twice, that could be worth $2,100. So why waste it? Now, in terms of a basic step-by-step guide of what to do, I would be starting off right now with a Roth IRA. This is a retirement account that you could invest up to $7,000 a year into, and then all of your profit is completely tax-free after the age of 59 and a half. For anybody who's young and just starting out, this is especially good for a few reasons. Number one, you're probably not earning a lot of money these days, so you're already in a low tax bracket and you'll have more money left over to invest. Two, you're young, so you have a lot of time for compound interest to do its thing. And three, practically every brokerage these days offers a Roth IRA, and it'll take you just a few minutes to sign up. Like, just to show you how great this is, if you sign up for one of these at 18 years old and you contribute $7,000 a year at an average of an 8% return, by the time you're 65 years old, you're going to have almost $4 million available to you completely tax-free. That is your entire retirement just from this one thing, done from a Roth IRA. And from that amount, you would be able to spend over $150,000 every single year for the rest of your life.
Congrats.
Enjoy. And lastly, if you want to dramatically speed up the process of getting ahead, here's a few quick life hacks. Number one, be obsessive. The truth is, if you don't love what you do, you're going to get burned out, you're going to let things slide, and someone else who is into that thing is going to run laps around you. So if you could start with passion, you're going to have a huge competitive advantage. Second, play to your strength. I truly believe that all of us are naturally gifted with one thing that you have an unfair advantage over. So if you could find it, lean into that. Third, act on opportunity. From what I've noticed, everything massive really just comes down to a few good decisions at the right place and the right time. So if something comes up and you see a fair opportunity, go and take it. Fourth, this one for some reason is really overlooked. Show up early. I'm shocked at how simple this is, but so few people show up on time that when you do show up on time, it's a rarity. Fifth, here's a big one. Don't complain. This one accomplishes nothing. It's wasted energy, and instead you should always reframe everything as a positive. Like if a client shows up late, well, that's a good opportunity to practice patience. If a deal gets canceled, well, that's an opportunity to prevent that from happening in the future. And when you could shift your entire perspective, you'll just constantly get better. And finally, 6, you have to stay consistent. Just like you can't expect to go to the gym for a week and get jacked, you can't expect to make these sort of changes and see any sort of difference in the next few weeks or months. Most likely, it's going to take years. And years of which you have to remain dedicated. Now, of course, there's going to be a lot more nuance than I could possibly put in a video like this without making it 3 hours long, but I promise, if you just stick with this long term, you're going to see a massive difference in terms of your accomplishments, how much money you make, and whether or not you hit the like button and subscribe if you haven't done that already. So with that said, thank you so much for watching. Feel free to comment down below because I will do my best to read and respond to as many of you as I can. Really appreciate it. Helps me out a ton. Thank you so much, and until next time.
So thank you so much for checking in here with me today. Hope you have an awesome rest of your weekend and awesome next week. I'll be doing a lot of this stuff for you. Catch you then.